Hey, welcome back. Previously, we spoke about liquidity ratios, and this chapter, we're going to talk about profitability ratio. So, by definition, this ratio would actually tell us how much or how profitable a company or a stock is. Let's jump straight to it. First of all, we are looking at gross profit margin. So again, on the top right corner, if you see a green box with an arrow pointing up, this means that the higher the value, the better it is. So the formula for calculating gross profit margin, you take the gross profit over revenue, and these can be found on the income statement of a company or a stock, so to say. So in this example, we are taking 500 million over $1 billion. We multiply it by 100%, so you get a gross profit margin of 50%. So what this 50% means, it's the revenue or the percentage of revenue after taking off direct cost of goods sold. So to put it simply, gross profit margin represents how much money you make after taking off the direct costs associated with producing and selling the goods or services. If we take this in the example of a fruit store owner, how do we express gross profit margins? So for instance, you buy one apple at 50 cents from a farmer. You sell the apple at $1 to your customer. Your gross profit margin is simply taking $1 of sales minus 50 cents, which is your direct cost of goods, and you divide it by the revenue of $1. So 50 cents divided by $1 multiplied by 100%, you will get a gross profit margin of 50%. So this 50% means is how much money you're making after taking off the direct cost that is associated with producing and selling the goods. The next ratio we want to look at is the net profit margin. On the top right corner, you see the arrow pointing upwards, so this means the higher the value, the better it is. The formula for net profit margin is taking net profit over revenue. So you can find these on the income statement as well. Assuming in this example, 100 million of net profit, you divide it by $1 billion, multiply it by 100%, so you will get a net profit margin of 10%. So this percentage is the percentage of revenue after taking off all costs. COGS stands for cost of goods sold. So it's a direct cost to produce and sell the goods. You take off the cost like administrative costs, taxes, interest, salaries, rent, any cost that you can think of, you will come to the final net profit. So if you are a business owner, net profit margins is referring to how much money or the percentage of sales that you can put it in your own pocket. In the example of a fruit store owner, to calculate net profit margin, so let's assume that you sell $1,000 worth of apples in a month. So that's your sales or revenue. Your total cost for the month is $900. So this includes cost of apples, rent, salaries, and ads. So your net profit would be 1,000 minus 900. So your net profit will be $100. To calculate the net profit margin, you take $100 divided by $1,000 multiplied by 100%, and then you will get a net profit margin of 10%. So as a business owner, for instance, if you have a net profit margin of 10%, your total sales is 1,000. That means you can take into your own pocket $100. The next financial ratio we want to look at is earnings per share, or commonly known as EPS. So this is a very common ratio that is used by financial analysts or investors to evaluate how much earnings is a share giving. So the formula for earnings per share is taking the net profit dividing number of outstanding shares. So assuming company A has 80 million in net profit in a year, and there is 100 million shares out there in the public. So you take 80 million, divide by the 100 million shares, you will get 80 cents per share. So to get the net profit, you can look for it in the income statement. For the number of outstanding shares, you can look at it in the annual report, or just Google number of outstanding shares for Apple, for Facebook, for any other company, and you will get the number relatively easy. So the number of outstanding shares does not normally change on a day-to-day or even month-to-month basis unless the company buys back shares or does a stock split to have more shares available on the market. Back to EPS. EPS shows how much per share earns. So assuming you own 1,000 share or 1,000 stocks of company A, and if the EPS is 80 cents per share, so technically you take 80 cents multiplied by 1,000 units of stock or shares you have, then you will get $800. So it's just a representation of how much per share can earn, or per share of the company can earn for the investor. So the earnings here is not that, in the example that you can take the $800 and put it in your own pocket, because this is at the discretion of the management of the company to use the earnings to reinvest into the business or distribute this as dividends to the investor. Remember, earnings per share is just a representation of how well the company is earning money, but you don't get the full 100% of that earnings per share. It is at the discretion or decision of the company to reinvest or distribute part of it as dividends to the shareholders. In the example of a fruit store owner, the earnings per share can be explained. In this example, for instance, you share the store with your brother 50-50, and the store is worth 1,000 shares. So each of you get 500 shares or stocks each. Let's just assume the store makes $1,000 per year. So this is net profit of $1,000 per year. Hence, your earnings per share will be your net profit divided by the number of shares. So it's $1,000 divided by 1,000 shares. You will get an EPS of $1. So it's just a representation of, how much the company can make per share. So taking net profit over the number of shares available is an expression. Yeah, the higher the better, of course. The fourth profitability ratio we want to look at, again, is also a very common ratio that is used by many to evaluate if the company is doing well or not. So this is the return on equity, or commonly known as ROE. Top right corner, arrow pointing upwards. This means that the higher the number or the value, the better it is. So the formula to calculate ROE is taking net profit divided by total equity. So if you remember from the balance sheet, a very simple formula on how to calculate equity is to take assets or total assets minus total liabilities. But really, the value or the amount of total equity, you can find this in the annual report or any financial statement fairly easily, and you don't need to calculate this yourself. For instance, if the net profit is $80 million, the company has a total equity of $800 million, you multiply it by 100%, you will get an ROE of 10%. So what does an ROE or a ROE of 10% means? This means, or rather it shows, how much earnings is generated from investments or capital. Maybe the word investment here is, not the best word to use for this instance. Maybe it should be presented as how much earnings generated from equity. But to give an idea, we are just trying to show from ROE how much the company can get in return from the equity invested. Elsewhere, you would have heard ROI, ROA, which stands for return on investment, return on assets, but ROE is a better representation of how efficient or how good the company is generating returns on its equity pool. Yes? So it's just a way to express and measure how well the company can generate returns. In the example of a fruit store owner, to explain ROE, assuming the store makes $1,000 a year in net profit, you have $10,000 worth of equity, taking all your assets of the store, minusing all your liabilities. 1,000 divided by $10,000 multiplied by 100%, you will get a ROE of 10%. So again, the number for ROE, the higher the better. So look out for companies that has good or high ROE values. So this pretty much sums up the profitability ratios that I wanted to talk about. So there are 4 that we have gone through. First, the gross profit margin is to measure how well the company is making money after deducting the direct cost of goods sold. Net profit margin, again, it's the margin or how much money you're making from sales clean to the shareholders after taking out all costs. You have earnings per share, is taking net earnings divided by number of outstanding shares. So it's a measurement to show how much the company can earn per share. Lastly, we have return on equity, ROE, is how well the company can generate returns on the capital that is deployed or available for the company. So for all these 4 profitability ratios, the higher the number, the better it is. So you may see or hear other profitability ratios out there, but really, I think you just need to understand and know and play with these 4 ratios, and you will be well off or good enough, right? So thank you, and we will speak again in the next chapter.